All right, well, we are half past the hour. We're going to go ahead and get started with day 2 of Sikich's 2024 Higher Education Forum. Thank you so much for taking time out of your day to join us, and thank you so much to GoToWebinar for actually working today. And for those of you that were with us yesterday and helped us navigate that, and were patient with our pivot, we certainly are grateful for that. So we're going to go ahead and get things kicked off right away for us this morning. For CPE, again, if you're interested in CPE and need CPE, we are going to use the same platform that we utilized yesterday for that, which is the Conferences IO platform here. To get that CPE, you can go ahead and check in to the link on the page here, or use the QR code from your mobile device there as well. Once you are there, you'll want to check into the session. For today's session, we're going to have 3 polling questions in Brian and Leslie's session, and then we'll have 3 codes in the second half of the session for our GASB update. We do have information presented in the handout section of GoTo, so you'll see information there in terms of the Conference IO resource guide, as well as handouts for today's sessions on that as well. So without any further ado, it's my pleasure to turn things over to Brian and Leslie.
Thanks a lot, Anthony. And thank you for spending your time with us today. Today we're going to briefly explain the tax reporting considerations for international students and foreign persons. My name is Brian Lake. I'm a director here at Sikich in the Alexandria, Virginia office, and I'm joined by Leslie Keller. Leslie,
Hi, I'm Leslie Keller. I'm a director in our tax services practice here at Sikich and specializing in foreign reporting as it pertains to US.
And if you want to learn a little bit more about us and what we do and what our backgrounds are, there's QR codes at the side there. So please feel free to take a look. So before we begin, I just want to mention that this is a general conversation, a general presentation. We are not providing legal advice. We are solely providing general information. If you have any issues with your unique situation, we would recommend that you speak to your accountant or reach out to any of us, and we'd be more than happy to answer your unique situations. So today we're going to discuss student visas. We'll explain that. We'll talk about residency status and why that's important, and how do student visas impact residency. We'll discuss withholding obligations on the payors side, and we'll talk about exemptions. What potential exemptions are out there regarding withholding or reduced withholding? We'll talk about the IRS compliant forms and what forms are out there that you need to be compliant about, what you need to consider. We'll also talk about tax treaty implications and how that affects withholding and whether or not somebody's taxable or whether or not somebody's treated as a resident. And finally, we'll go through some examples. But before we begin, we have our first polling question. What question has come up most often within your organization related to foreign reporting? Payments to non-persons? Operations in a foreign country or international affiliates? Alternative investment reporting? Or it hasn't come up yet? Take a few minutes and answer that. And Anthony, if you have a chance, let me know when we're finished.
Will do. We'll give folks another 20 seconds or so here, and we'll see what we're looking at here. All right, so here's our results here. So we have our top answer here was the most common one was payments to non-US persons, which were 50% of our responses. We had 8% each for operations in a foreign country or with international affiliates and alternative investment reporting. And 35% of our respondents said that it hasn't come up yet.
That's good to know. We know a lot of people are in the right place. Making payments to non-US persons is what we're actually going to hit on today, but thanks for that. So student visas and residency status. So according to Forbes magazine from November of last year, international enrollment in US colleges and universities are up some 11.47% from the prior year. There are currently just a little over 1 million foreign students studying at US colleges and universities, up from 948,000 the prior year. So you can see US education is the interest in US education by foreign students is up. Moreover, it's the fastest growth rate in more than 40 years. International students make up 5.6% of the total number of college students in the US. And so that's why today's discussion is very important, in that there's 1 million foreign students out there who potentially have some US tax exposure, maybe a filing obligation, maybe withholding. But more and more, it's becoming an issue. And more, the service, I expect, will look into this and challenge people and make sure that people are being compliant with their withholding obligations. But before we go further, let's talk about the two most common visas that international students have while present in the US, the J1 visa and the F1 visa. Now, J1 visas are for individuals participating in approved exchange programs. So generally through universities, maybe cultural missions, maybe on an international visit. J1 visas are very common. Now, in order to get a J1 visa, you have to be sponsored by the exchange program. So first they get accepted for this exchange program, then they apply to the State Department to get the J1 visa. Now, students may work legally in the US if part of an approved program, but the whole idea is that the J1 student visa is for somebody, it's for a specific purpose. That is, for the exchange, they're here for a certain purpose. The purpose is not to work legally here in the US, though they may. Now they can work, but it's limited to certain amount of hours, they just won't permit them to work entirely during their stay. So my comment is, yes, they can work here, but it's usually, they have to be approved and receive permission to work here. Students may remain in the US for up to 18 months of practical training. If they are employed or if they receive some compensation in this period, they are not subject to FICA. So Social Security and Medicare, individuals on a J1 visa are not subject to Social Security and Medicare on that compensation. And more importantly, days spent in the US on a J1 visa are exempt from the substantial presence test as enumerated in the Internal Revenue Code 7701B, and that's for the max of 5 years. Now under 7701B, individuals who are present in the US for a period exceeding 183 days out of a 3-year period, they'll be considered as residents. And we'll talk about residency in a moment and why that's so important. But days spent in the US on a J1 visa are exempt from this substantial presence test. You need to consider that. And J1 visa holders, accordingly, because they're exempt from this 7701B, they're always considered as non-residents of the US. So similarly, F1 visas are for international students. However, they are specifically for individuals attending an academic institution full-time, which leads to ultimately a degree or a certificate. So similar to the J1, you have to be sponsored by the university. And individuals are permitted to work, and they still need permission from the university to work. But one important factor with the F1 visas as opposed to J1, F1, the students can transfer from one school to another. So that's an interesting distinction. F1 visa holders are not, though they're initially sponsored by that university, they can switch from one school to another. F1 visa holders can apply for an extension. They are similar to J1 visa holders, not subject to FICA on compensation that they earn while on that F1. And similarly to J1 visa holders, days spent in the US while on an F1 visa are exempt from the substantial presence test. So in general, they're always considered non-residents of the US. So why does residency matter? We talked about 7701B, and the way you, once again, the calculation is you take into account current year's days plus 1/3 of the prior year's days plus 1/6 of the prior year's days. And if that number is greater than or equal to 183 days at year end, you're considered a resident. Residency is important because if you're a resident of the US, you're taxed on your worldwide income. Non-residents, that is people who don't meet that substantial presence test, are only considered taxable on what's considered US effectively connected income. That is income relating to services performed in the US. So that's an important distinction. Worldwide versus only effectively connected income. Now, US citizens and green card holders, by definition, are always considered as residents of the US, taxed on their worldwide income. So residency matters. If you have a J1 or an F1 visa, the days spent in the US are not going to count towards a substantial presence test. They're always generally going to be considered as non-residents. So I jumped the gun a little bit. Residents are taxed on the worldwide income. Residents file Form 1040, a US individual income tax return, just like you and I. Non-residents of the US, again, are only taxed on US effectively connected income, and that there's certain limitations. Non-residents are obligated to itemize their itemized deductions. They can't claim a standard deduction. When filing a 1040-NR, they're obligated to file, generally, a 1040-NR, which is a non-resident income tax return. And if those individuals happen to be married, guess what? They're obligated to file as married filing separate, unless, of course, they're from Canada, Korea, and Mexico. So non-residents filed Form 1040-NR, a non-resident individual tax return. All right, here we are at our second polling question. When reporting questions arise on payments to foreign individuals or foreign students, our organization utilizes internal resources, an outside advisor. We guess and move on, or it just hasn't come up. If you can spend a few moments, please, and answer those polling questions.
All right, so we've got our results here. So when reporting questions arise on payments to foreign persons or foreign students, organizations are utilizing 50% are utilizing an internal resource, 24% are using an outside advisor, 4% are guessing and moving on, and for 22%, it has not come up yet.
Excellent.
I like the honesty.
I like the answer too.
The guess and move on.
Yeah, the guess
Fine order. Yeah. Take the chance sometimes.
I'm going to hand over to Leslie.
There we go. Next slide. We're going to now talk about the withholding obligations and exemptions. Thanks, Brian and Anthony. I'm going to cover the next two sections, the next two topics on our agenda, starting with the withholding obligations and exemptions. Next slide, Brian. So there is a special income tax withholding regime applicable to payments that are made to non-resident aliens. This requirement falls under the Internal Revenue Code 1441. Note, this withholding does not apply to a resident alien. So this is where that student status is important to determine in advance to determine whether or not you have a withholding obligation. The general rule is a withholding agent must withhold tax at a 30% rate on a payment of a U.S. source income to a foreign person. There are many exceptions to this general rule. We will go over what is a withholding agent, what is determined to be a foreign person. Let's look first at what is determined to be U.S. source income. That is scholarships, fellowship grants that are sourced based on the location of the payer. So in most cases, that will be U.S. sourced coming from your education system. Compensation income is sourced to where the services are performed. So this may be inside or outside the U.S., thinking about where the individual is actually performing those services. If it's foreign sourced income, withholding is not required under this code section. Next slide, please. So moving on to what is a withholding agent? Any person or entity with control over a payment made to a foreign person, which is characterized as income that is subject to withholding. So this includes payments of scholarships or fellowship grants to a non-resident alien student or teachers or researchers. The university is the agent even when making the payment on behalf of another party. So for example, let's just say something like the Mellon Foundation grants a scholarship to a Spanish student to study at your US university. The Mellon Foundation is going to provide those grant funds to your university to disperse to or on behalf of that student. The university, in this instance, is the withholding agent and may have the obligation to withhold on those payments if applicable. Next slide, please. So a foreign person is defined, oddly enough, as not a US person. A foreign person is any non-resident alien student, teacher, or researcher. A foreign national is considered to be a non-resident alien for withholding purposes. Under the code section, only if the person meets the following requirements. They are not a resident of the US for federal income tax purposes. So again, going back to what is their status. They're considered a resident of a foreign country under a residence article of an income tax treaty, which we're going to cover this a little bit later. Or they're a resident of one of the 5 US territories, Puerto Rico, US Virgin Islands, Guam, American Samoa, and the Northern Mariana Islands. Keep in mind, an alien electing to be treated as a US resident for income taxes, which is a special election they can make, is still considered a non-resident alien for purposes of withholding. So again, going back to knowing the status of the individual as it pertains to US taxes. Next slide, please. The general rule requires a 30% withholding. So what are the exceptions to this general rule? Here are some items that you should consider. First of all, being the classification of the payment. Is it for services? Is it a wage that's going to require a W-2 reporting? Or is it a payment to an independent contractor and perhaps subject to that 30% withholding requirement? Or is it a scholarship or grant? Then is there some exemption under the Internal Revenue Code that applies to that payment and then can be excluded from gross income? So is it a qualified scholarship eligible as a tax-free payment? It would need to meet the following. The amount cannot exceed the qualified education expense. It cannot be designated or earmarked for other purposes such as room and board. It cannot be a payment for teaching, research, or other services as a condition of the scholarship. Other exemptions include qualified tuition reduction, which is often a situation where an employer would offer that to their employees. And another exemption would be the Educational Assistance Program, which you may provide to students you employ at your university. Also consider income exempt under an income tax treaty or eligible for a reduced rate of withholding below that required 30%. Keep in mind, though, the withholding agent must have properly completed withholding tax certificate, otherwise they are required to withhold. Next slide, please. So the withholding agent is personally liable for any tax required to be withheld. Failure to withhold may result in penalties and interest, even if the foreign person has satisfied that tax liability. The penalty may range from 2 to 10% and is based on the date withholding was required to be deposited with the IRS. Keep in mind, a bona fide scholarship or fellowship grant may qualify for this reduced 14% withholding, and that falls under Section 1441B of the Internal Revenue Code. Next slide, please. So there's some special situations that arise when you're making these payments. It may be difficult or next to impossible to withhold tax from that payment. The withholding agent may elect to pay the tax out of their own funds and resulting in additional income to the individual. This is so-called the tax on tax rule, which then becomes this circular calculation. So as a result, the IRS requires this gross up formula to be applied to a payment to impute and remit tax on the person's behalf. The formula is shown on the slide where the total payment is the initial payment, and you take that divided by 1 minus the tax rate. So we have an illustration here on the next slide. So a college is going to award a scholarship to a foreign student who's in the US on an F visa. The foreign student is a resident of a country that does not have an income tax treaty with the US. So we're going to say perhaps Brazil. The scholarship is to be applied to tuition, mandatory fees, books, plus room and board. The fair market value of that room and board is going to be measured based on what the university charges a non-scholarship student. So in this example, it's $6,000. So the room and board is subject to tax, and it's not like you're making a payment out to the individual that you can withhold on that $6,000. So the taxable amount of the scholarship, then the university says will cover the tax. So going through the formula and the calculation, the withholding rate is going to qualify for the 14% reduced rate instead of the 30%. The taxable amount of the payment then becomes $6,977, and the college will remit that $977 to the IRS. And then this amount is reported to the student. And we'll get into a little bit more on the actual forms that gets reported in our next section. Next slide, please. So that $977 in our previous example, those federal deposits are withheld and required to be made using the Electronic Federal Tax Payment System, or otherwise known as EFTPS. This is most commonly known as what is used when you do your payroll filings. The frequency of that deposit is going to depend completely on the amount that is being withheld, and it may be a monthly payment, a quarterly payment, or an annually payment. It's outlined in the instructions for the deposit and the form. This will then get reported at year end on a Form 1042. It's an annual withholding tax return for which you have withheld tax on payments to these foreign persons, and it is a summary form that then is remitted to the IRS. Next slide, please. So now moving on to those lovely tax forms that follow all of this reporting. There's, next slide, Brian. Thank you. There are forms that are required to be completed by the foreign student or foreign person to support that reduced rate of withholding or the exemption from withholding by the agent. Failure to properly receive these completed documents from the student, the agent is required to withhold from the payment, even if they would otherwise be eligible for this reduced rate. These forms required are going to depend both on the classification of the income and the person receiving it. Going back to earlier in the slides when we talked about, what is the source of income and what is the status of the individual? Are they resident or non-resident? Non-resident, this applies, this withholding applies. So our next slide. So this is probably the most common form related to a non-resident alien, and that would be the Form 8233. This is an exemption from withholding on compensation of a non-resident alien. This form advises the withholding agent to not withhold on the tax payment, and this exemption from U.S. tax withholding is on payments that qualify under a tax treaty between the U.S. and the foreign person's home country, their resident country. It's generally going to be used for compensation. However, it may also be used when in connection to that compensation, they're receiving scholarship or grants. And again, coming from that same agent, that same university. And the student who receives the scholarship and works for the US, they can request that exemption for both of those items on this form. Unlike these other forms, this form does have requirements to meet necessary remittance and documentation. Most informational forms you receive from a student, you just retain on your files. This one actually has requirements for filing. The withholding agent must review the completed Form 8233 to make sure it is accurate. If the form is incomplete, or if the agent has any reason to believe that the information on the form is incorrect, that form cannot be accepted, and then the agent is required to withhold. If the information on the form is conflicting with the records you have, or there are errors or omissions, it isn't complete, it isn't signed off by the student, or perhaps they put down this country for a tax treaty and we don't have a tax treaty with that country. So if it isn't accurate, the form can't be accepted. If the form is complete and it is correct, the agent now signs off on the form and submits it to the IRS. This form has to be submitted to the IRS within 5 days of acceptance. Most of your informational forms don't have any type of requirement like that. So in addition to submitting it to the IRS, you keep a retained copy in your files and give one to the non-resident alien student. If after acceptance you discover that the form is incorrect, the person doesn't qualify for the exemption that they claimed, the agent is required to immediately notify the IRS in writing and start withholding on any remaining payments that are to be made to this individual. This submitted form is effective until the IRS notifies you that it objects to that form. So because there's timing and processing involved, there are regulations that allow the IRS 10 days after you've mailed the form for them to object, for the IRS to object. So it's highly recommended when you remit those forms, you retain a certified mail receipt to prove that day you mailed it. So should the IRS come back, and we all know the IRS is very behind on processing paper, and these are remitted in a paper form, you would have proof to show they're beyond the 10 days, you cannot object, that, and this would stand if the information is accurate and complete. This form is only valid for one tax year and is required to be refiled each year. So you have somebody here for a 5-year period on a visa that, they're exempt, they would have to redo this form for you every year. Next slide, please. So a couple of the other forms that you may encounter as it relates to foreign students include the W-8BEN. This is a certificate of foreign status, and I'm losing my voice here for a minute. So this information is generally provided by a non-resident alien, and it's to advise of applicable treaty exemption for income other than compensation for services. So this would not be the form you would get from a client, from a student who is performing services. This is most involved with scholarships and fellowship grants. The form is actually effective for a 3-year period. It's going to be good through the 3rd year after the year in which it was signed. So assuming that there's no change in the circumstances, the information that was provided on the form, and that is complete and valid. So a form completed, say, November of 23 is going to be good until December of 2026, December 31st of 2026. The other form that is on here or forms that you're probably most familiar with, these are the common residency forms that we see, or U.S. person forms, is a W-4 form, which is your employee withholding certificate. It's required for U.S. payroll reporting. Keep in mind though, even though you are required to put them on payroll, they may be exempt from Social Security and Medicare, even though you're reporting these forms. W-9, this would be a request for taxpayer identification number for payment to resident aliens that are not employment compensation. If they're employed, they're going to be getting a W-2. If they're not, then you would do the W-9 and issue a 1099. Next slide, please. So like the 1099, there is this 1042S. It is very comparable in respect to a 1099. However, its purpose is to report payments to a non-resident alien that are either exempt from tax withholding or eligible for reduced withholding. Payments made include receipt of non-qualified taxable scholarship. The form reports the gross payment and the tax remitted on behalf of the payment to the IRS. It also indicates if there is some treaty position that we've taken reduced withholding from the 30% required. And this is an annual filing that is required to be completed by March 15th of the following year. So the 2023 tax year, just closing from a calendar year, these are calendar year forms that require reporting back to the student. And this is where the 1042S would need to be issued for 2023 in no later than March of 2024. Next slide, please. So the references that are really good from a source material that I've covered today, first is the IRS publication 515. It's a great resource for withholding on non-resident aliens. Please make sure that when you are looking at the publication or any of these forms listed, that you are pulling the latest version of the forms and instructions. The IRS has modified some of these forms in an effort to assist with their focus on the foreign reporting. This is a big area of focus on the IRS going forward for various reasons. And they've been updating these forms to allow their systems as they're modernized to detect some of these filings. The 1042 for the very first time is now an e-filable form as of 2024 and is required to be e-filed. Lastly, one form I didn't mention here is the W-7 form. This is the form that the student would use to obtain a U.S. individual tax identification number, otherwise known as an ITIN. This application is submitted by the individual, and the issued ITIN would then be provided over to the payor, your university, and then included on these various reporting forms. Most of these informational forms do require that ITIN if they are registered here in the U.S. And now I'll turn it back over to Brian to cover the tax treaties.
Excellent. And if I can make just one additional comment regarding this W-7, we've got a lot of clients who've come to us who need ITINs, and we need to complete these W-7s. Please keep in mind that when you submit the W-7, they're going to want original, they're going to want copies or certified copies, original copies of source documents, oftentimes passports, birth certificates. Oftentimes people don't want to submit this to the service, especially when it may take them months to respond, and who wants to be without their passport and the birth certificate for all those amount of time. There are intermediaries, certified acceptance agents out there, which will help you get that W-7 and certify copies so you don't have to give the originals. And they actually send it into the service on your behalf. And once the service gets that, they issue the I-10. So be aware that W-7, they're going to ask for a lot of original documents, and a lot of people are really hesitant, and not, I can't blame them either for submitting those documents. So keep that in mind. Certified acceptance agents are out there. They can help you with that W-7, and it's going to take time. Great. Well, let's talk about tax treaty implications. Leslie had mentioned that there's certain exemptions out there for individuals who are residents of treaty countries. And just for your information, the U.S. has approximately 56 income tax treaties out there with foreign countries. Chile was the latest one back in December 19th of last year, to enter into an income tax treaty with the U.S. And mind you, Chile is the only country in South America that the U.S. has an income tax treaty. Recently, as of January in 2023, the U.S. and Hungary terminated their treaty. So we don't have a treaty with Hungary, nor do we have a treaty with Russia anymore. That was terminated back in January for obvious reasons. So basic treaty considerations and requirements. And this is important. Basic treaty requirements is that the individual be a resident of a treaty country. If you have somebody coming, for instance, from Brazil, coming to the US, we don't have a treaty with Brazil. So there's no treaty benefit that the individual could potentially claim, unless, for instance, this Brazilian person lived elsewhere. So for instance, let's say you have a Brazilian national who was resident in the UK prior to coming to the US to study. That individual would be considered a resident of the UK. They can utilize the US-UK treaty for exempting certain items of income in the US. So keep that in mind. Resident doesn't necessarily mean citizenship. You can be a Brazilian citizen resident in the UK who comes to the US. So keep that in mind. You just can't you just can't automatically say, no, this guy doesn't have a treaty, there's nothing to apply. It can't apply. All income tax treaties do contain provisions relating to the taxation by one country of scholarship, fellowship grants received by the resident of the other country. They also provide some exception for source country taxation on compensation. So we'll look in a few minutes, but some countries that we have treaties with say a certain portion of US sourced income may be exempt. Now, oftentimes there's limits, and that'll be in the treaty itself, and limits as in regards to how long and the amounts that can be exempt from taxation in the US. But keep that in mind, there are portions, there are articles in some treaties which exempt a portion of US sourced income. Now, non-resident students who claim treaty benefits under an income tax treaty must file a U.S. non-resident income tax return in order to claim treaty benefits. You just can't say, look, we're exempt from under the treaty. No, you have to tell the U.S. government that you're exempt under the treaty. You have to file a 1040 NR, and you have to file a form indicating that you're taking treaty benefits, the 8833. There are, as I mentioned, certain exemptions articles in the treaties. Two general types of exemptions are exempt scholarship grants received by the student from outside the U.S. Potentially, those students may remain subject to tax on non-tuition fee portion of U.S. source scholarships, fellowships, and grants. So keep that in mind. They may have a scholarship outside the U.S. They may have a scholarship in the U.S. The one outside the U.S., depending on what the treaty says, may be exempt. And on this situation, be considered as foreign sourced, it would be exempt. But U.S. sourced, it may still be taxable. In addition, there is the U.S. oftentimes permits the entire scholarship or grant to be exempt, and as well as room and board and other expenses. So keep that in mind. Not all treaties are the same. You really have to look to the treaty to see what is exempt, what's not exempt, and to what extent and what time limit is out there. So in general, U.S. income tax treaties have, with broad scholarship exemptions, also contain an exemption for personal services earned by the student in the U.S. So again, look to the treaty. A lot of treaties contain limited exemption for somebody who's studying in one treaty country but earns compensation in the other. The exemption, once again, the exemption does have time limitations and oftentimes income limitations. That being said, we're coming to our third polling question. Do you typically determine whether an income tax treaty exemption applies, or do you rely on others to make that determination? Please then take a few moments and answer that question, please.
All right, we'll go ahead and close this here. And our results are that 28% of the respondents are making that determination, while 72% are relying on others.
So I'm glad people are realizing that there are treaty exemptions out there too, so that makes me happy. But yet, and realize that not all students are the same. People come from different places. People are resident in different countries. So not all treaties are the same. Not all students are treated the same. Not all international students are treated the same. I'm glad to see that. All right, now let's go through a quick example where we're taking into account a treaty situation. So in this situation, Nabila is an Indian national, lives in Mumbai. She's a senior at a local high school in Mumbai and dreams of one day studying mechanical engineering at a university in the US. She's applied for and been admitted to Caltech in California. Knowing that the cost of attending Caltech is $28,000 a year for tuition, books, and fees, and another $8,500 for room and board, much more than her family can afford, Nabila has applied for and been awarded a full scholarship for $36,500. by a local Indian association in Mumbai to attend Caltech in the fall. She plans to get a part-time job tutoring on campus. She expects to receive $2,000 from part-time employment on campus, and she'll be in the US on an F1 visa. So there's a lot going on here. I think we're going to look at the treaty. Nabila is concerned as to whether or not the value of the scholarship will be taxable in the US. She's concerned she may also have to file a US individual income tax return. She doesn't even have a social security number or ITIN. What do you recommend? Let's think about this for a few minutes. She doesn't have an ITIN. Oh my, that's going to take a lot of time. You're going to have to file that W-7. She's got 100% foreign sourced scholarship. Let's see what the treaty has to say. And she also has compensation from part-time employment. Let's see what the treaty has to say. So this is Article 21 of the US-India Income Tax Treaty. And paragraph 1 of Article 21 says a student or business apprentice who was resident of one of the contracting states immediately before visiting the other contracting state, and who is present in the other contracting state principally for the purpose of his education training, shall be exempt from tax in that other state on payments which arise outside that other state for purposes of his maintenance, education, or training. These were written by attorneys. The treaty is basically saying if we have foreign sourced income and the person immediately before going to the US, that other contracting state, is going to that other contracting state for purposes of their education, that foreign source payment's not going to be taxable in the US. So under Article 21, the scholarship, that foreign source scholarship, is exempt from US taxation. Moreover, it's not reportable. It's not reportable because it's a foreign scholarship. So this is how we interpret the treaty. The treaties are oftentimes very difficult to understand. They're written by a bunch of attorneys. So keep that in mind. If you have issues with foreign students and whether or not a scholarship paid abroad is taxable, look at the treaty, reach out to some others to help you. But in our situation, in our example, it should be exempt. See what the answer is. Nabila is considered a non-resident of the US. She's on an F1 visa, right? So it's fully excludable. Her scholarship is 100% foreign sourced. So, and it's from an Indian entity. It's exempt from US taxation. Moreover, there's no reporting there. She doesn't have to report the scholarship and can claim a treaty exemption on her US individual income tax return. The code provides very limited exceptions for the sourcing of that compensation. If it's US sourced, the US India Income Tax Treaty only exempts the scholarship, tuition, room, and board. The compensation that she earned is not exempt. It's taxable to her. She'll have to file 1040-NR, which is a non-resident income tax return. She'll need an ITIN. She'll need an ITIN. You're going to have to get that W-7 prepared. She's going to have to get that. She'll have to either go through a certified acceptance agent, or she's going to have to give up her source documents to the service. Once again, I'd be very hesitant to do that. So you need to get that W-7 done as soon as possible. Why? Because you're going to have to pay her. She's going to have to be paid somehow. And you're going to have to be able to remit federal and state tax, and you can't do that without an ITIN. So that's just a common example.
So Brian, before we move on for our takeaways, let's, on your example, from a standpoint of reporting, there would be the W-2 in this case. It wouldn't be subject to Medicare or Social Security, but it would be subject to federal and state taxes. She would be filing a federal non-resident return. She would have to file a California return. So as the University of Payor, they're going to need the documentation you mentioned, the W-7. She's going to have to produce an ITIN. You're going to end up getting a W-4 form from this individual because you are going to be adding them to your payroll and withholding the taxes. And then the individual will request assistance probably on trying to figure out the US tax filing. I mean, US people struggle to figure out the US tax filings. I can only imagine how foreign people feel coming into this country. So just taking this particular example, we have an Indian treaty with the US. And in this case, that was a foreign payment coming from India with regard to the scholarship. But if we take that same exact fact pattern and we say that scholarship is now coming from the US, and it is now covering both the qualified education expenses and the room and board, again, we'd look at the treaty and our result would be different perhaps than what you just explained. We would have additional reporting requirements here in the US, correct?
Absolutely, yes, you would. And if it's from US sources, potentially the tuition may be exempt, but the room and board itself will be compensatory. And the question is, do we have a withholding obligation? And the answer is yes, you do. And how's the university or college going to handle that? Are they going to gross it up? Most likely gross it up. But yes, it's compensatory, and she'll have to file a return reporting that income. And she'll also claim the gross up as a tax withheld to offset the tax on that amount. But yeah, most definitely it's going to be taxable. So it's a different situation where the sourcing of the scholarship is. Is it overseas or is it here in the US?
And then also just looking at Nabila, in this case, she was a citizen resident of India. If we take that as a citizen of India, and let's just say she moved to the Cayman Islands, and then from Cayman, she was a resident and came to the US, we don't have a treaty with Cayman. And as a resident of a country without a treaty, again, we have a totally different set of circumstances. And that's where understanding, the background of not just where they're a citizen, but where are they claiming residency and where do they validly have a residency to claim to make sure that exemption will stand, and in turn protect the university from any particular withholding obligations. Again, this is going to go back to the university. If they were required to withhold, that's where the focus is going to be. If, even if they make the tax payment and everything is settled, the IRS still could come back and say, you had the obligation to withhold, and therefore this is the charge. And one of the focuses of the IRS right now is penalties. They're identifying penalties as a revenue stream. So if you want to move into our takeaways, Brian.
Before we do that, Leslie, can I just, we did have one question from the audience that came in going back to the gross up illustration. And the question was, if the tuition and fees in that example were greater than the $20,000 scholarship, would there still be a taxable income situation if the recipient owes the balance in excess?
And that's where you're going to have to look at what are the actual qualified expenses that would be excludable first. Because if the amount of scholarship is not fully covering the qualified expenses, then you're not going to have a reportable situation here. It's going to be based on the total that has been awarded, and then the total of the qualified expenses, and then the difference, if there is any, could become a taxable event.
Perfect. Thank you.
Mm-hmm.
Okay, let's talk about our key takeaways. I think the biggest takeaway we get from this is you need to know who your international students are and where they're from. You need to know your people. You need to know your students, because not all students are taxed the same for US tax purposes, are treated the same for US tax purposes. So know the foreign students. Secondly, understand the classification of income. Do we have foreign source? Do we have US source? What's being paid abroad? What's being paid in the US? Can obtain those completed forms, the Form 8233 in particular, that exempts certain income. Realize that potentially you have a withholding obligation, and universities, as the withholding agent, you have to realize that potentially if you don't withhold, you're subject to the tax. You're responsible for that tax. And of course, remit the tax as required in a timely fashion. File all the necessary forms, be it a 1040NR, be it the 1042s, be it the 8233s. Realize what's out there, the forms that are required for these foreign students. Beware of the exceptions, because there are exceptions to everything. That Brazilian person who's come to the US and they were resident in Brazil, be aware, you really can't take a treaty position there. But maybe they came from the UK and we can take a treaty position. So be aware that there are exceptions there. Not everybody's treated the same. And then finally, I would recommend that you consult with your advisor, because there are so many unique circumstances out there. Not everybody's treated the same. And to be careful. With that, if there's any questions, we'd be happy to take your questions now.
And I guess one thing to add on that, Brian, we focused here mostly on students, just from the standpoint of these are the foreign students coming into the US that have these reporting requirements. You guys are paying foreign people other than just students, whether you have perhaps a affiliated university overseas and that person's coming over here to perform or to do some type of service or do research. You have a lot of other situations other than a student that's here on a specific visa. And now those circumstances, how is that person here? What is their status? Do they have a visa to come in? Are they here, just for a short-term visit? And what are your withholding obligations on any payments to those persons? So that kind of takes this whole presentation even further, which is why I really think, as you look at each situation, you cannot make the assumption that everybody coming from a specific country is treated the same way with regard to payments and withholding.
Most definitely. And especially too for US people outbound. Let's say you have a professor outbound, and how's that individual being taxed? How long are they going to be overseas?
Yeah, that's a whole other, outbound is a whole session separate from this.
Right, exactly. But there are unique situations out there, and we just recommend that if you have those unique situations that you reach out to somebody, reach out to a specialist who knows the ins and outs, and making sure that you're in compliance with your obligations. So with that being said, thank you so much for your time, and once again, please reach out if you have any questions.
We did have one other question, guys, if I can throw one at you here.
Okay.
If we'll do this here. So it just came in here. So question is, our coaches want us to gross up and cover the 14% tax with their scholarship. How will this affect the student when they file the 1040NR?
Well, it depends on what the scholarship is. Is it just for tuition? I mean, what's it for? But if it's compensatory, you gross it up. Yeah, and it's compensation to the individual. Yes, absolutely. But
and that 14% will result in whatever they withhold and they add to the gross amount. That will be tax paid and credible to them on their individual filing when that student goes to file. And if there's any excess tax, yes, that excess tax will go back to the student. So I know that has always been, a topic of conversation. Are we grossing up something where in essence we're now just giving the student additional cash? But then the flip side is, as the university, if it's a taxable payment, you're required to withhold. So, when you can document any type of exemption or exception, it's definitely helping both sides.
Right.
Hopefully that answers the question. I mean, they'll get the tax credit for it.
Excellent, thank you. All right, well, Brian and Leslie, thank you so much for your time this morning and sharing your expertise on. There's not many things that I find myself going through and seeming no pun intended here, that seem like a foreign language to me after as long as I've been doing this, but kind of going through, certainly learned a lot this morning on that. So thank you both. We're going to go ahead and take a 10 or maybe 11-minute break here and reconvene at 40 past the hour with our GASB update, as well as our in our next section here on uniform guidance and student financial aid section here as well. So we'll have you join us back at 40 past the hour. Thanks, everyone. Please, if you aren't already connected with the three of us on LinkedIn, we'd love to have the chance to connect with you. I do share quite a bit of information on our respective pages on there as well. So I'd encourage you to get connected and keep up to date on all the happenings, some of which we'll talk about today. For the GASB portion of our update, here's what we're looking to cover. Here's what we're planning on addressing with you this morning. So GASB Statement 101 on compensated absences, GASB Statement 100 on accounting changes and error corrections, as well as looking back on, I'm sure what is one of everybody's favorite standards in recent memory, GASB Statement 96 on subscription-based information technology arrangements, or SPIDAs. So we'll cover some of the key things that we learned as we went through and assisted our clients with implementations of GASB 96. What are some of our key takeaways for this morning? Looking at understanding the impact of GASB 101 on compensated absences, looking at Statement 100, identifying and understanding the different types of accounting changes and how those could impact your financial statements, whether those be impacts to your basic financial statements, the statistical section of your financial statements, RSI, required supplementary information. And then finally, we'll look at those key lessons that we learned through the implementation of Statement 96. Starting off with Statement 101 on compensated absences, though, this is, in my opinion, another standard that, while different in subject matter and ultimately different in treatment than what we saw on, the most impactful recent pronouncement, Statement 87 on LISA, Statement 94 on P3s and APAs, and Statement 96 that we just noted on SPIDAs for that. Statement 101 continues down that path of looking at reporting liabilities and looking at ensuring that the full amounts of liabilities are reported on your financial statements, and getting into a little bit more of the theoretical on some of these pieces and how this is calculated here. But again, within the overall framework that we've seen GASB operating, it's not out of line with what we kind of expect from them in terms of what they're trying to do with this standard. So ultimately, GASB found in going through its standard due process related to Statement 101 that there was a lot of inconsistency in how compensated absences were being reported. Also, they had really seen an evolution of what compensated absences were in terms of the types of compensated absences that were out there. Started off when GASB issued its initial pronouncements out that, it was the standards, vacation time, sick time, and didn't have necessarily some of the nuances there that we see now, or combined types of compensated absences, whether that be flexible time off or overall paid time off, where all of those different types of compensation or compensated absences may be rolled into one type of time off that you're offering to your employees there. So the objectives of the standard were to enhance the recognition and measurement guidance here, and as well as looking at redefining the disclosure requirements for that. And from an effective date standpoint here, this is effective for periods beginning after December 15th, 2023. So years ending December 31st, 2024 and thereafter. So on the good news, you do have a little bit of time to go through and gather the information for this, start coming up with your assumptions that you'll use that we'll talk about here as well as part of this process. So we know what GASB's objectives are here. We know what they're trying to do as part of this standard. How are they going to do this? And what are they going to provide that's going to ensure that they meet these objectives? Well, again, they want to have an alignment of the recognition and measurement guidance as to how compensated absences are reported, as well as getting rid of some previously required disclosures as part of that. Now, GASB's intent here is to present a liability, or have you present a liability that more accurately reflects when your organization is incurring an obligation for compensated absences. Finally, it's also going to provide a more robust estimate of what those amounts are for compensated absences as well. You're going to have the, whether those amounts are going to be paid out or settled by your organization, by your institution for that. This estimate, Statement 101, GASB believes will provide a more robust presentation and calculation related to that figure. For us to understand how to gather this information and go forward, however, though, is we need to look at what GASB now is defining as a compensated absence. So as we can see here, the compensated absence is first, leave that employees use for time off with pay. B, leave for which employees receive payment upon termination of employment. Or C, leave for which employees receive settlement through other means. Those settlements through other means can be a variety of things, but one common one is conversion to post-employment benefits. Now, compensated absences generally, and again, there's exceptions to this, but generally don't have a set payment schedule. Things that could fall under this definition, that GASB looked at as part of the standard, or vacation leave, sick leave, paid time off, holidays, parental leave, bereavement leave, as well as other certain types of sabbatical leave. Some of you may have sabbatical leave at your organizations that could potentially be something that's required to be gathered and tracked as part of this standard and calculated as part of this standard. Now, when we look at the definition here, a couple things that we need to focus on. First of all, the definition of termination of employment. So termination of employment is going to refer to as the end of an employee's active service. That can occur for any reason, voluntary resignation or retirement is part of that as well. Also, one thing to note here, this does not include benefits that are within the scope of GASB statement number 47, which is accounting for termination benefits. So if you do have something that falls under the GASB 47 guidance, you do not need to incorporate that into your calculations, and you should not do so related to your GASB 101. Ultimately, we come down to three simple questions that we're going to ask ourselves when determining what that compensated absence balance should be. First, does the absence accumulate? So here we're looking at absences that can be carried forward from the reporting period in which they're earned to a future reporting period, at which point they're going to be paid or settled as part of that. Is that compensated absence more likely than not to be either paid or settled through other means? So at this point, you need to kind of really consider some other factors as part of that as well. Whether you have employment policies related to those compensated absences, and what's the historical information on payment of those amounts, among other considerations. And then finally, is the absence or is the compensated absence attributable to services already rendered? So in this case, we're looking at services that our employees have already performed to earn that compensated absence or to earn that payment or settlement. As we look at how we calculate the compensated absence balance, once we've gathered all of the information, we're going to come up with a total amount of the accumulated leave that meets our criteria for that as well. We'll then multiply that by the employee's pay rate, and that's going to provide us with our compensated absence liability here. Now, the employee pay rate should be as of your balance sheet date that you're calculating that amount there, so the rate that they would be paid out if that compensated absence had to be paid at that particular date and time. So your balance sheet date, what we're looking at there. As always, if you kind of ask yourself the question based on this is, what would we have to pay as part of that? That's a starting point for this. And then we'll go through the other considerations as well. Also important to note, and the standard goes into more detail on this, but you may have certain salary-related payments that are both directly and incrementally associated with those compensated absence payments. We'll cover those in more detail in a little bit later in the presentation, but those would also be included as part of your liability. Now, we do find ourselves in the somewhat rare situation where GASB actually has
taken away a couple of disclosures, as we've gone through and implemented, going back as far as the pension standards, the OPEB standards, and more recently 87, 94, and 96. We actually have a couple situations here where we can actually scale back a couple of our note disclosures there. So a nice change of pace from GASB in terms of that aspect here. But historically, you needed to report compensated absences as gross amounts there. So you'd have your beginning compensated absence liability, any increases to those amounts during the course of the year, any use of those compensated absences, and then finally come to your ending compensated absence liability. For those of you that participate in the Government Finance Officers Association or GFOA certificate program there, if you ever have presented just a net amount on that schedule there, you knew that's something that you would like me to get a comment on if you netted those amounts there. Well, good news under 101, you do have the ability now to present a net change. You would just want to note that it is a net change when you present that in your notes to the financial statements. The other requirement here just relates to governmental funds. Are talking about which funds have previously liquidated that liability. So in most cases, not going to be applicable for you in the higher ed space there. But again, a couple of situations here where GASB did take out some disclosure requirements here. So we provided the initial definition as we look at recognition and measurement considerations here under Statement 101. Well, let's dive a little bit deeper into the specific categorizations as well and the definitions here for these three criteria that we talked about. One thing to note here as we look at talk about whether or not the absence is more likely than not to be paid. We are looking at the lowest level threshold here. So 50, more than 50% means it's more likely than not to be paid or settled through other means. An example here, so we talked about that the absence has to accumulate. So it can be carried forward from one reporting period to the next as part of that. So if we have an employee, for example, who does not use all of their vacation time in the year, they have the ability to roll that vacation time forward to the next year. That would be something that does accumulate from a compensated absence standpoint. In contrast to that, paid holidays, for example, those are often linked specifically to the actual holiday itself there. You're not likely to accumulate those amounts there. Again, there may always be exceptions to these, but generally speaking, that's how those are going to be treated there. Second piece here, again, a simple statement here. Have they already earned the compensated absence? Have they done the work? Have they rendered the services required to earn that compensated absence? I mentioned this earlier, but just talking a little bit more about whether or not an absence is likely to be paid or settled through other means. You may need to look at various factors, and we'll go through some of these as well here. What are your employment policies? Do you have different classes of employees that are covered maybe by different bargaining agreements, things of that nature? Do we expect that certain benefits may become eligible for payment in the future as part of that as well? Historical precedent also comes into play here as well. For any of our Sikich clients on this, we talk often about looking at something from a substance over form standpoint here. So maybe something isn't clear in terms of whether or not it has to be paid out upon separation from your organization or your institution as part of that. However, if you don't, if there's no policy on it and it's silent, but historically for the last number of people that have left the organization or left your employee as part of that, and you've paid those amounts there, then again, we look at that on the substance over form standpoint, and likely that may be something that you need to include or consider shoring up the policy or looking at the policy to make sure that it is current and addresses it in the way that you expect it to be. Also, if you have a situation where maybe a particular absence or particular component of the liability maybe hasn't been paid out in the past, but you know that there are changes coming about that would require you to do that, or whether those be legal changes or things of that nature, then factoring those into that liability as well. As we look at that rate of pay, going back to that calculation and what we're talking about there, any changes to the rate of pay should be recognized in the period of change for that. And then if you're going to use if you have a situation where you're paying out a portion of that time, for example, here. So if you're paying out sick time at 50% of that rate there, then you want to use that rate in terms of what's going to be calculated as part of that. Specifically within the higher ed space, one consideration that you may have to look at here is whether or not you have, if you have sabbatical leave here. And sabbatical leave, the answer as to whether or not this would need to be reported for your organization is it depends here. So it's what type of sabbatical leave do we have here? So if the employee is not required to perform any significant duties for the organization during that sabbatical, GASB classifies that as what they call unrestricted sabbatical leave. If it is not, if the employee does have job responsibilities of a different nature during their sabbatical, so if they have to do research, if it's a research sabbatical, as opposed to teaching, which is their normal function for that there, the sabbatical would not be considered a compensated absence, again, because they're doing work as part of that time. So GASB really, again, looking here at time off being paid not to work in this case. Unrestricted sabbatical leave, as we look at paragraph 8, can accumulate when there's a minimum service period. So for example, if an employee or professor, faculty is required to have 7 years of service to receive that unrestricted sabbatical leave, then that leave would accumulate over that 7-year period there. When we look at whether it's more likely than not that the employee is going to utilize that sabbatical leave, you want to consider the likelihood that they're going to be employed long enough to actually use it there. And then what's the likelihood that they're actually going to use that leave? Talks a little bit here about the measurement focus. GASB didn't change this much in terms of kind of how they want this reported on the financial statement. So I'm not going to spend a lot of time here just for the sake of time. Retroactive implementation is required here if practicable for periods, prior periods presented. Again, disclosing here if it is not practicable. As noted, if you've been to previous presentations that Sikich has done, this not practicable language that GASB has included in recent standards is something that they intend to be a pretty high bar there. Not because it's a nuisance to have to go back and calculate those amounts or you don't want to, and then say it's not practicable. So keep that in mind as you're looking at these and trying to be able to go through and do that. So I want to spend a little bit of time here kind of looking at an example from the impact standpoint here. So this is a municipality, a governmental entity here that has gone through and looked at compensated absences, and they did an implementation back in 2022, so they early adopted this standard. You see the note disclosure here where they disclose and provide information that employees are able to accumulate earned but unused leave, including sick leave, vacation time, compensatory time, and holiday leave, in this case for their police only. The entire balances of those are recognized as a liability at year end, and then sick leave being recognized as a liability if it is more likely than not to be used or otherwise paid in cash. So you see again the language directly from the standard here as well. Talking about how they're reporting that liability here, the benefit piece as well. So when we look at this example here, you'll see that the compensated absences here, they've noted the reporting for this. So you'll see in the middle of the page there, the 2.2 million, which is a restated balance. They presented a net change here. So you'll see that that's a net change here. They just disclose a net change in liability. When you look at the change in accounting principle here, the note disclosure, Nick will talk a little bit more about that as we continue through today's session on that in GASB 100 here, but our change in accounting principle. So in this case for this organization, they had about a $650,000 increase to their overall compensated absence balance as a result of the implementation of Statement 101. So I want to go through some examples here because in terms of looking at the definition, ultimately you're going to need to come to the conclusion as to whether or not you have to incorporate something here. So some illustrations for us to go through here. First one, paid time off that is earned each month, carries over without limit at the end of the fiscal year, and for which any unused leave is paid upon termination of employment. So in this case, pretty straightforward. This is included. This is a compensated absence. Many organizations have moved to that paid time off or FTO, whatever you want to call it, model for vacation, sick time, kind of all of those things encompassed into one category there. We see in this case that the leave does accumulate because it's carrying over at the end of the fiscal year. It is attributable to services already rendered because they're earning it each month. And because they don't have any limits on that, they are paying that out upon termination of employment there. So again, all of this would be considered a compensated absence liability. Next example is sick leave that is earned each month and carries over without limits at the end of the fiscal year, but any unused leave is not paid upon termination of employment. So under the old guidance, generally this would not have been something that we needed to report or include as a compensated absence liability. GASB 101 makes us think about that and change that a little bit more. So how do we look at this now? So you might have sick time, you might offer sick time to your employees or in some capacity for that. Oftentimes you can accumulate that, but I would say in the majority of situations that sick time is forfeited upon termination of employment. So when we go back to our definition and look at our criteria, does the leave accumulate? Yes, in this case, it does accumulate because they can carry it over without limit at the end of the fiscal year. Is it attributable to services already rendered? Yes, again, in this case, we know that it is for services already rendered here, and they're earning it each month as part of that. Now, the part that's different here is we have to look at whether or not it's likely to be paid or settled through other means. Now, paid in this case, it's not going to be paid. That we know that from kind of what we have in the illustration, what we said there, not paid upon termination of employment. However, what we do have to look at here is if we expect the employee to utilize any of that portion for sick time. So this is where the estimate comes in. This is where you have to look at things from a historical standpoint to say, okay, well, if employee A has 100 hours of sick time at year end, 50% of that sick time, potentially, they may actually utilize as time that they take off and receive pay of, when they are sick or taking care of, other, family members that may be sick, and they're using that sick time to do that if your policy allows for that. So you have to come up with an estimate as to what portion of that sick time is going to be, again, paid, in this case, none of it, or settled through other means. So that's the use of this sick time there. Pretty much the largest change that we see on this standard. If you're wondering, well, how do I go about coming up with that calculation? It's a great question. As part of that, going through and just determining what you need to do and kind of what you want to have in place in terms of an estimate for that. Doing a 3 or 5 year look back as to say, okay, how much sick time was used out of the percentage that is out there for that, gives you a chance to kind of go through and do that as well. Another example here, sick leave that is earned each month. It does not carry over at the end of the fiscal year and is not paid upon termination of employment. So in this case, it's not going to be included. And why? Because we're not carrying it over at the end of the fiscal year. So there's no accumulation here, so we don't have to report anything. Sick leave earned each month. It does not carry over at the end of each calendar year and is not paid upon termination of employment. So a bit of a trick question here, a bit of a, words matter situation here. But if the calendar year and fiscal year do not coincide, then you may have a situation where you need to look at that from a timing standpoint as well. So again, mindful of what your policies say and how those policies are structured. Vacation leave that's made available on the first day of the fiscal year or at the inception of employment for an employee, added to their time bank. It's not reconciled if an employee terminates during the year. It carries over at the end of the fiscal year without limits and is paid upon termination of employment. So we do have circumstances in which some organizations add leave for their employees into their time banks or into their vacation banks at the first day of the fiscal year or when they're first hired for a new employee there. So in this case, looking again at our criteria, it does accumulate because it carries over at the end of the fiscal year. Now, because we're not reconciling it, if they terminate during the course of the year, we can consider it to be attributable to services already rendered as part of that. So that's the differentiation here if we're not reconciling that. So that's what makes this that's what makes this need to be included as a compensated absence liability. Finally, on compensatory time, this is a lot of it as employees work overtime, carries over at the end of the fiscal year. In this case, we have a state statute that's driving that says unused time is not forfeited and is required to be paid upon termination of employment for that there. So again, this could be offered for a variety of reasons for that. It is attributable to services already rendered, it is accumulating, and it is required to be settled there. So I got a lot of information on this. You do have a little bit of time from an implementation standpoint. I encourage you to start gathering the information, start coming up with those assumptions as you look at Statement 101 and where you need to be, so you're ready to implement that standard when the effective date does come due. That brings us to our second code of the day for you to enter into Conferences.io. Our second code of the day is 385. Second code of the day, 385. We'll give you a second here to jot that down or to enter it into the system. And we'll go ahead and turn things over to Nick to talk about accounting changes and error corrections. So second code, 385. And with that, I'm going to turn things over to Nick.
Thank you, Anthony, and hi everyone. Thanks for joining us today. Real quick, my name is Nick Bava. I'm a partner, an audit partner in our government services department, and happy to be here today to talk through a few things related with GASB. So we're going, in the interest of time, we're going to jump right in. We're going to be talking about GASB Statement 100. Anthony, if you don't mind going to the next slide. So GASB Statement number 100 is on accounting changes and error corrections, and it is an amendment of GASB Statement number 62. This new standard is in effect for fiscal years beginning after June 15, 2023. So common fiscal year ends that this will be required to implement. We're looking at June 30th, 2024, December 31st, 2024, and April 30th, 2025. Now, this accounting pronouncement is intended to streamline the reporting of accounting changes and error corrections along with the related disclosures in governmental financial reporting. So, for example, one of the challenges with prior period adjustment guidance and Statement 62 was that financial statement preparers were really unsure of how to apply that guidance in certain situations, which ultimately led to a lack of consistency across government. So the differences in applications meant one governmental entity was reporting a restatement. We're reporting similar restatements in different ways. So one government might report an accounting change, while another government might report a similar changes in error correction. And ultimately, GASB Statement 100 clarifies the accounting change categories and provides guidance for reporting and disclosing those changes. So this standard will apply to all governmental entities, and it will impact how entities define an accounting error or a change. And it clarifies what represents an accounting change or an error correction and guides us on how these changes need to be presented in these financial statements. So what this next slide here that Anthony is showing us right now shows us are these four categories, and we'll go through these really quickly. They bucket accounting changes into three categories: change in accounting principle, change in accounting estimate, and change to or within a financial reporting entity. And then the fourth category is a correction of an error in previously issued financial statements. So we'll take each one of these categories and go through them in more depth. Next slide, please. So changes in accounting principles. So a change in accounting principle is a change from one generally accepted accounting principle to another generally accepted accounting principle on the basis that it will improve your entity's financial reporting. So this category also does include the implementation of new accounting pronouncements, most recently the adoption of GASB Statement 96 on subscription-based IT arrangements, which I'm sure most folks have adopted or are in the process of adopting currently. Now, most accounting pronouncements include transition guidance in the last few paragraphs of that standard. Going forward, however, accounting pronouncements will only have transition guidance if they're different from what's prescribed here in GASB Statement 100. So using Anthony's last standard that he covered on compensated absences, Statement 101, the transition guidance provides an effective date, and then it references Statement 100 for further transition guidance. Now, GASB Statement 100 does require changes in accounting principles to be applied retroactively by restating the beginning net position or fund balance, with the exception of required supplementary information or supplementary information, which should only be restated for the periods presented in the basic financial statements. Periods that are not included in the basic financial statements do not need to be restated. Next slide, please. So accounting estimates, we have a few slides on. Accounting estimates, very simply put, are defined as amounts subject to measurement uncertainty that are recognized or disclosed in the basic financial statements. There are two parts to calculating an accounting estimate. The first is the methodology, and the second is inputs. A change in an accounting estimate applies only to a change in inputs in most cases, and a change in methodology in most cases is going to be considered a change in accounting principle. Next slide, please. So from an example standpoint, when we look at changes in accounting estimates, say your entity capitalized a capital asset and depreciated that asset over 35 years using the straight line method. If your entity decided to change that straight line method to the double declining balance method, assuming that change is justifiable in terms of qualitative characteristics of your entity's financial reporting, this change would be considered a change in accounting principle. Now, on the other side, if after receiving new information, once this asset was previously capitalized and it wasn't available at the time of capitalization, say the useful life changed from 35 years to 25 years, that change in useful life would be considered a change in estimate. And the distinction is important because unlike a change in accounting principle, which requires retroactive change, Statement 100 requires that changes in accounting estimates be reported prospectively by recognizing the change in the reporting period in which that change occurred. Next slide, please. So the next category is the change to or within the financial reporting entity. And the guidance on changes within the reporting entity is new guidance rather than a clarification of old guidance from Statement 62, which really only addressed changes to the reporting entity. So changes to the reporting entity typically resulted in the addition or removal of component units, while changes within the reporting entity usually result from the movement of funds from major to non-major, or changes in a component unit's presentation as blended or discretely presented. Now, changes within the reporting entity should be reported by adjusting the current reporting period's beginning balance for the effect of the change as if the change occurred as of the beginning of the reporting period. Now, this may result, if you've seen a presentation, it may result in awkward presentation in a year that, for example, a fund moves from major to non-major, as you have to have the requirement of having to show that previous beginning fund balance. Now, fortunately for a lot of the folks in the line here in the higher ed space, reporting on the single business type activity model, you don't have to concern yourself with major or non-major fund reporting, but this will apply to your municipal governments, your county governments, and so on. Next slide. So our fourth and final category is the correction of an error. Error corrections come from mistakes found in financial reporting, right? So according to this statement, mistakes are derived from calculation errors, errors in implementations of standards, or oversight or misuse of facts. Now, if we look at the example that we shared about that capital asset, and we consider that same circumstance, say when entering that capital asset for the first time, and you wanted to capitalize that asset using a 25-year useful life, but accidentally input 35 years. That would be it. That would fall under the category of a correction of an error. Now, error correction should be reported retroactively by restating all prior periods present. And when making error corrections, the entity is required to make changes to any RSI previously reported and included in the report for all prior periods impacted. So very critical when you have a correction of an error as far as looking back and updating those prior periods presented in accordance with what this section of the standard calls for. Next slide, please. So this is a great summary slide that I certainly suggest you bookmark it. It captures all of the four categories that I just highlighted and the way in which you restate your financial statements in accordance with these types of changes. So certainly suggest you take a picture or bookmark this page, and if you do come across these types of changes or error corrections, you come back to it as far as how it will impact your financials. Next slide, please. So from a display standpoint, now the guidance also prescribes how changes are presented in your basic financial statements. It requires that changes be disclosed in a tabular format in the footnotes, while also presenting the aggregate amount of adjustments on the impacted statements in your financials. So the restatement disclosure should reconcile the beginning balances as previously reported to the beginning balances as what is referred to as restated. So the new format really ultimately is intended to standardize the reporting of accounting errors, changes within the reporting entity, and changes to accounting principles to ultimately make it easier and more consistent for users of the financial statements to understand the overall effect. Next slide, please. So from a note disclosure standpoint, very simple. These are the types of components that you should look to capture when disclosing these types of changes and corrections in your footnotes. So from a summary standpoint, look to describe the nature of the change or the error and its correction. What was the reason for the change and the overall effect of the beginning net position and fund balance, and then the restated net position or fund balance presented in tabular format. Last section I'll cover related to GASB Statement 100 is on RSI and SI, required supplementary information and supplementary information. So the prior standards did not really address required supplementary information such as pension schedules or supplementary information because they predated the standards that really addresses these items. So very simply put, periods earlier than those presented in the basic financial statements should not be restated for changes in accounting principles. However, periods earlier than those presented in basic financial statements should be restated for any error corrections if practicable. And again, as Anthony mentioned, that bar is pretty high. So it's not like it's an easy exclusion if it's not if it's too much work or anything like that. So that if practicable is a high bar to meet in accordance with the standards there. All right, so that covers GASB Statement 100. As Anthony mentioned earlier today, we're going to just touch on a few items related to GASB Statement 96. You know, we spent about a half year so far through this implementation process with our clients. We've learned a lot from an audit standpoint. We've learned a lot from the experiences that our clients have shared with us as well. And we thought it'd be a great opportunity just to hit on some of the highlights, the key components that we've at least learned so far for your benefit, whether you've implemented or not at this stage. Next slide, please. So these next two slides that we'll cover touch on the subscription term, and a lot of the content related to this section pulls from language and guidance straight from the standard itself. So what we've learned up to this point is that the subscription term, we cannot reinforce how important your understanding of the term for a potential SPIDA contract is. It's critical to obtain the contract information and the master services agreements, and to be able to provide that to us as auditors to support your conclusions is very critical. Now, paragraph 9, we wanted to point out that periods for which both the government and the SPIDA vendor have an option to terminate without permission from the other party are considered cancelable periods and are excluded from the subscription term. So this is one of the common outs that we have seen related to reviewing contracts up to this point. A lot of contracts have termination clauses for both sides without cause to terminate within, say, 30 or 60 days notice. If that is the case, that would be excluded from needing to implement on GASB 96. But again, that's why this language is important to review in conjunction with, with your contracts. What you might think is a 5-year SPIDA really only could be a 30 or 60-day SPIDA depending on termination clauses. Next slide, please. Staying on the topic of subscription term, this should look very similar to what we're used to seeing with GASB Statement 87 on leases. A short-term SPIDA is a SPIDA that at the commencement of a subscription term has a maximum possible term under the contract of 12 months or less, including any options to extend, regardless of their probability of being exercised. So that 12-month window is really your sweet spot in terms of understanding if that contract is considered short-term or not. It's very consistent with what we've seen with leases, but just wanted to point out and reinforce that when you're really honing in that subscription term, look at paragraph 9, look at paragraph 13, see if these fall in line with the contracts that you're reviewing. In addition to subscription term, one thing that we wanted to touch on was the commonality of prepayments with GASB Statement 96. With leases, for example, those payments are usually more recurring, right? Recurring and due, 1 month after the next or annually. What we've seen that might apply to your entity are prepayments of subscription-based IT arrangements. And using an example, say if you had a 5-year subscription and the SPIDA vendor allowed for a lump sum prepayment before the start of that subscription term. In most cases, right, you would previously account for that prepayment as a prepaid expense on your balance sheet. Assuming that there are no future subscription payments required other than the lump sum payment, you would now report that as a SPIDA asset, a SPIDA intangible right to use asset, and amortize that balance over the remaining term of the subscription. Now, if future payments will be required in addition to that lump sum payment, and you plan to exercise those payments and options, then you would also potentially have a liability in addition to a SPIDA asset. So always review your prepayments and determine if, as part of your review of this statement, if any of these fall under the umbrella of Statement 96. Next slide, please. So as always with standards that are new with GASB, materiality is a common and a fair question that we get in terms of does it play a role in implementing GASB Statement 96. And this language is directly from the standard paragraph B9. The board concluded that a threshold should not be set to specifically exclude small ticket SPIDAs from the scope of this statement. So what does that mean? That means that you shouldn't be looking at your SPIDAs on an individual case-to-case basis. You need to be looking at the totality of your SPIDA profile and then determine from there if that balance and value is material to record on your financial statements. And that's where you work with your auditors to determine what's material and what's not. But it's important to remember that you're not looking at these contracts and agreements on a case-to-case basis. You have to look at them in the aggregate. So these next few slides we'll touch on are some Q&As from an implementation guide most recently issued by GASB. This is the implementation guide 2023-1. For those that aren't familiar with these implementation guides, they're issued for the public to view. They're really great resources that clarify, explain, and elaborate on GASB statements. So this particular guide touches on some Q&A from GASB 87, GASB 96, and GASB 100. Now these few questions that we'll go through touch on Statement 96, but again, they're real life Q&A that have been entered from the public, reviewed by GASB, and provided back to the public as it might be a very relevant type of situation for your entity when evaluating these standards. So looking at this first question here, is a licensing agreement for a vendor's computer software that automatically renews until canceled a licensing agreement that provides a perpetual license? So when you look at what a perpetual license is, it's a purchase in which a government is granted a permanent right to use the vendor's computer software. So in this case, the answer to this question is no, as a provision under the licensing agreement automatically renews until canceled, and that is considered an option to terminate the agreement at each renewal date. So it's important to understand the distinction between a perpetual license and one that automatically renews. Next question is, for the purposes of determining the applicability of Statement 96, do software as a service, platform as a service, and infrastructure as a service contain a combination of IT software and intangible capital assets? And the short answer to that question is yes. So I think most commonly folks associate Statement 96 with software as a service, SaaS. What this question is really clarifying is that it's important for your entity to look for those agreements that might be described as a platform as a service or infrastructure as a service, as they are common deployment models of cloud computing arrangements. You could have components that contain a combination of IT software and tangible capital assets. One might fall under the umbrella of GASB Statement 87 if it's more significant towards the tangible capital asset side. So this is a great example of the types of agreements that you should be looking for with your implementation. Then finally, just a kind of a straightforward Q&A. A government enters into a 6-year SPIDA contract with no options to extend or terminate the contract and begins making semi-annual subscription payments to the vendor immediately after the contract takes effect. So the initial implementation stage is not completed until the end of the 2nd year after the contract takes effect. What is the subscription term? I think it's very easy to think that the subscription term might be 6 years, but because of the fact that the implementation stage wasn't complete until the end of the 2nd year, that is what drives your subscription term. So going back to the first few topics I covered, really understanding the types of stages that apply when implementing a SPIDA and triggering, what would truly be the term in accordance with the standard. So from a lessons learned perspective, maybe for those folks that have joined us today that haven't implemented GASB Statement 96 and you're beginning that process, you're deep into that process, just some key takeaways. Certainly suggest you give yourself and your team enough time for a thorough and complete implementation. Really start to work with your departments to pull the contracts together, have the contract and master services and language and amendments, whatever that might be, all together to really provide a complete holistic view of a potential SPIDA. I know that it'll be good for your entity to have a sound documentation in place, but it will also be critical for us as auditors to review that contract language to support the conclusions. In addition, review your general ledger for usual suspects that might fall under the, that might be associated with software. It's certainly much trickier for us to identify what a SPIDA expense might be in the P&L. Look at your prepaids and so on. As always, communicate with your auditors early and often. We certainly appreciate a proactive approach with our clients as opposed to maybe starting the process during final field work. But again, always communicate early and often, be proactive there. And then finally, leverage any external tools if necessary. There are a wide variety of tools out there related to Statement 96 that help with the implementation, the calculation of values, the journal entries, and so on. And then lastly, going forward, I think as much as we would all like to implement and forget, it's important to remember that this is now an accounting policy that will be part of your year-end close process, your audit process, and so on. So just some things to think about going forward. As always, with any key accounting policy or any key element to your financial statement, segregation of duties is a pretty critical item. So always segregate your duties with Statement 96, preparing journal entries that need to be posted, reviewing and approving journal entries, and then having good recording and maintenance of the amortization schedules associated with Statement 96. Second, completing and maintaining appropriate documentation. Overall, this really provides consistency in the process. It's a good training tool, and it's critical for continued compliance with the standard. And then finally, and probably most important, is communication. Communication really can help your government efficiently accomplish tasks, right? Such as completeness of IT contracts, populations, communicating these requirements to entity stakeholders, training your staff throughout your government, and then really importantly, providing timely identification of any new or amended IT agreements. So that concludes the topic centered around GASB. We appreciate you listening to myself and Anthony on Statements 96, 100, and 101. And we certainly encourage anyone from your institution to connect with us if you have any questions related to your implementation. So now that the GASB section has ended, we will transition it over to Ray Krause, who will cover topics centered around uniform guidance and student financial aid.
Okay. Okay, my name is Ray Krause, and I just wanted to introduce myself as well. I'm an audit partner at Sikich and been with Sikich for a number of years and work in the higher education institutional area, work a lot with colleges, universities. So happy to be here today. I'm joining Anthony and Nick on the great presentation so far on GASB. I'm going to switch it up a little bit and talk more about institutional eligibility. That's kind of where my area of focus is. Now, we're not going to be able to cover everything on institutional eligibility, of course. It's a very broad area, but I just wanted to make sure we, touch on things that I think are important and some of the things I decided to bring up today in our conversation. Okay, some of the key takeaways. First of all, we're going to talk about the eligibility and certification report, making sure institutions are eligible with that, and the program participation report. Also know, what consumer information is required by prospective students, and also be sure that you're complying with the Graham-Leach-Bliley Act. First of all, for institutional eligibility, two things to keep in mind. Obviously, your state license has to be up to date, and also your accreditation. I know campuses that are multi-states for certain colleges, obviously they could be dealing with more than one state, and those licenses could have different expiration dates. So being sure that those are obviously up to date as well, and also your accreditation. I know it's a very time-consuming fact. A lot of times the accreditations go on at the same time as the audit, so we really make sure that those things are being taken care of. As far as the ECAR, the Eligibility and Certification Approval Report, this is really a vital piece of information. Obviously includes all the elements of the institution, name, address, the types of financial aid they participate in, whether it's Pell, direct loans, SEOG. Most schools would have most of those. Teach programs is limited with some schools that have it. It also includes the academic calendar, whether your school is on a semester basis or a trimester basis, and also the educational programs that are offered. You know, if it's a non-degree program, associate's degree, obviously bachelor's and master's degrees. It also includes obviously your effective date, when the ECAR was effective originally, and then of course, typically they're effective for 6 years, unless obviously you're a new institution. The creditor information should be included on that, and also your state authorization as well. In the official section, this is a key area as well. It's going to contain the name and titles of key officials at the institution, whether it's the president, the financial aid director, vice president of finance, those key individuals that would appear on most institutionals' ECAR. Additional locations, that's important. There's a lot of schools we work with that have some branch campuses, satellite campuses, anywhere where there's that actually instruction or that educational program is more than 50% is held at that outside location. It needs to be included in your part of your campus. So you should make sure you're aware of it. And one of the things that the Department of Education would do, or we would do as your auditor, is, you know, we're going to look at your school's website, and your school's website is going to usually identify all the locations. So we would match that to your ECAR to be sure that any new location that you just started, maybe just start conducting education that's included on your ECAR. Obviously, the educational programs, the program degrees, all the degrees you're granting, whether the credit hours are listed on that, if you're a credit hour school, of course. Make sure you review your ECAR, because obviously programs are constantly added and dropped. Sometimes I've seen, unfortunately, schools with situations where they granted financial aid for a program that wasn't listed on their ECAR, and that obviously could cause some significant problems. The other thing that I think schools sometimes forget to do is when there's changes to any of these things we've talked about, you are required to notify the Department of Education within 10 days. So if you have obviously a lot of presidents, I know we work with a lot of schools that are retiring presidents, so that would be a key official that notification should occur. Other financial aid directors, things like that happen. Or as I mentioned, schools develop a new offsite campus that they're using, that would have to be communicated to the Department of Education as well. And that needs to be done, obviously, on a timely basis. Next is the program participation agreement. This is kind of a contract with the U.S. Department of Education that allows you to participate in Title IV aid. That was obviously the Title IV Aid Act of 1965. That's going to apply to all your locations on the ECAR. So if your students, no matter where they're attending, obviously they're going to be a part of that program participation agreement. The first two certifications are important because we're going to talk about those in a little more depth during this presentation. The first two certifications are having a drug abuse prevention program and also having the campus security policy and crime statistics. Other compliance requirements in the PPA, we're going to talk about a few of these in more detail, but we'll want to quickly go over some of them. Obviously, Title IX, Title VI, FERPA, the Age Discrimination Act. We're going to talk quite a bit about consumer information, including the GLBA as well. And keep in mind, we're going to talk about GLBA in a little more detail a little later, but any breach of security information, that's really the gist of this whole program, is that could consider lack of potential administrative capability if you're not complying with that. And we're going to talk about that at the end of the presentation. Other provisions, Obviously, the schools really required to minimize their fiduciary responsibility, or having fiduciary responsibility to minimize time requesting Title IV funds and dispersing to students. It's spelled out. You can't ask for the money and not give it to the students timely. You can't charge for application for federal financial aid. You can't require them to pay money to fill out a FAFSA. And then finally, bonuses are very key too. Schools are allowed to pay. I shouldn't, maybe it's not worded right, but schools are allowed to pay bonuses or commissions to individuals at a school. However, they can't be tied to secure enrollment. So your registrar can't be paid a bonus depending on how many people are admitted, or admissions department. Those type positions are key, where you can't pay a bonus based on number of students that they admit. There's also a couple other certifications. Lobbying, of course, can't have lobbying when you have federal funds. And the drug-free workplace, we're going to talk about in a couple slides, because it's really emphasized in a lot of different places, including obviously the program participation agreement, making sure you have that notification. Some other certifications I mentioned that have in that drug-free awareness program. That information should include things like the danger of drug use at the workplace, the policy on maintaining a drug-free workplace. There's a counseling available, and then obviously describing what those penalties would be should a person violate the drug-free program. Each employee should have a copy of that. Key things to note, though, there's a couple things we'll talk about here. Employees should be notifying the employer if they're convicted of a criminal drug statute within 5 days of conviction. So that's important, because then there's some reporting that happens with the school back to the DOE. So in order for that to be done timely, you have to encourage your employees to notify you of any drug conviction. And then, as I mentioned, institutions have to provide that drug-free workplace. And what has to happen, of course, is institutions have to notify the department within 10 days of receiving notice. So once the school has received notice, the school has then 10 days to notify the Department of Education. And then, of course, then there has to be action taken as well. And that action could be either suspension or termination of the employee, or if the school has a drug rehabilitation program, that they could refer that employee to as well. So all that timing has to be done, and that's all specified in the program participation agreement. Debarment, suspension, other related matters, institutions are really confirming when they have that program participation agreement that they've not been suspended or debarred, and can't be convicted of a commission of a fraud or criminal offense within the last 3 years. I mentioned earlier about having that drug and alcohol abuse program, and really that distribution of that program should be both to employees and students. It needs to be in writing, really talking about the conduct that prohibits unlawful possession of illicit drugs, a description of legal sanctions that could happen, obviously, with that in that case. And obviously, the other thing too is description of the health risks of use of drugs as well. So that program has to incorporate all those elements. In addition, it has to mention descriptions of treatment programs. I mentioned if your employees, if you have a rehabilitation program, you could refer employees or students to. And then, of course, a clear statement on what sanctions the school would impose should an individual be convicted, or and that sanction could be as far as termination. Obviously, for a student, it could be suspension or expelling those students. So, and then really making sure there's a biennial review of the program to be sure you're following the sanctions that are listed in your program itself. Next, we're going to get into some required consumer information. Obviously, there's a lot of consumer information we could be talking about today. We can't discuss it all, but what I'm going to really highlight on is really the Clery Act. I know there's other consumer information, could be things like graduation rates, employment rates, things like that. We don't have, in interest of time, we're going to stick to one area here, and we're going to talk about the Clery Act because I think it's very, very important and applicable to all institutions. Really a little bit of a history of the Clery Act. It goes all the way back to 1965 with the Higher Education Act. However, in 1990, Congress passed this Crime Awareness and Campus Security Act. And then in 1998, it was renamed the Clery Act. It was named after actually a student who, in memory of a student who was murdered actually in her dorm. And then 2013, there was some modifications again, And really, they added some of the VAWA, or the Violence Against Women Reauthorization Act, added some additional amendments to the Clery Act. So that's kind of where we are right now with it. What are consequences of the violations? Very steep. Fines up to $35,000 per violation. We're going to talk, next slide is going to really stick out as some big numbers that could happen. And obviously, the Department of Education could limit or suspend your financial aid, which would be obviously detrimental to institutions, and of course, not be able to participate in the Title IV program. I mentioned the Clery Act. Here's a list of some of the larger fines that made the news in the last 10 years. Baylor was fined $461,000 with something within the football program. UC Berkeley was fined $2.35 million. University of North Carolina, 1.5. Of course, the Michigan State is still now the largest ever Clery Act reporting. That was a $4.5 million penalty. Prior to that, the Penn State issue with the former coach that with abuse, that was $2.4 million. So you could see these amounts are very substantial, and obviously could really impact an institution from not only a financial standpoint, obviously reputational as well, which is definitely hard to obviously quantify. In the actual financial state handbook, there's actually a Clery Act appendix, and I'm not going to be able to talk about all the issues and things there, but there's some very important things that are really basics that are included in the appendix. How to collect and classify, report crime, how to issue campus alerts, disclose missing student information procedures, keeping a daily crime log. There is an annual security report that you are due to report by October 1st. You have to submit crime and fire statistics to the Department of Education, provide educational programs, campaigns on how to prevent some of these issues, of course, and of course some fire safety information as well. First of all, the first area is part one of the Clery. It's really reporting. I mentioned you have to do an annual security report, statistics for the 3 most completed years. The appendix is going to really include some of the new things as well. As I mentioned, 2013, the Hate Crimes and Additional Violence Against Women Act includes some additional statistics to monitor as well. They included the new things were domestic violence, dating violence, and stalking. Those were added back in 2013, as I mentioned. Schools that have campus safety or a actual local police would designate what's called a CSA, which is a campus security authority, and that person is responsible, obviously, to have the duties to be able to understand what that reporting entails and have the responsibility for all the student activities. So whoever is designated that CSA, it's not necessarily security, it could be someone, even a VP of a certain area, whoever is designated as a CSA has that reporting responsibility. Next, we're going to talk about geography, because that sometimes gets confusing with schools that are in rural areas or in in the middle of cities, things like that. It gets confusing. What is really the geography? What are you responsible for as an institution? What is considered your campus? So there's some definitions, of course, here. You can see here, campus is defined as a building or property owned by or controlled by the institution within the same reasonably contiguous geographic area. And that's going to include buildings that are next to the area, obviously with like a parking garage or dormitories, that's part of it. But where it gets a little more tricky or a little more confusing is it's also includes parts that are controlled by institutions that may not be right on campus. For example, if you're using a bookstore that's down the street from the campus that's owned by the university, that would be part of the geography. If you have a food service that's not adjacent to the campus, but it's part of it. But also keep in mind too, I know a lot of schools, in fact, my daughter goes to a school where her dorm, her freshman year, had a Subway in the first floor of her dorm, and that Subway is obviously run by an outside place. However, it's the building they're in is owned by the institution, so that becomes part of the geography for the Clery Act. So be careful on that situation. What gets trickier, of course, is the Department of Education doesn't necessarily define what a reasonably contiguous is. However, kind of the rule of thumb that the approach I've taken is is it part of the campus map? So if I went online or I had a campus map of your institution, and if I saw that building on that campus map, I'm going to probably consider that as reasonably contiguous. That's part of your campus, whether that bookstore or that outside food venue place is part of it. That would be part of your geography for the Clery Act. What's non-campus building or property? That's something that's also something to be considered. It's really something owned or controlled by the student organization. That would be something like a fraternity house, a sorority house, things like that, or a building property owned, controlled by the using direct support. We'll talk about these in the next slide. Is it frequented by students, even if it's not in the same reasonably contiguous area? And we'll talk about that on the next slide. What are the examples of that? As mentioned, that first part would be like a fraternity or a sorority. That campus bookstore located off campus, that's still part of it. The sporting event, obviously your football stadium could be not right in the middle of campus. It could be real in the out part of campus. That would be part of your geography. But also to be really concerned with is when you have off-campus facilities. For example, I know a lot of schools would do soccer camps or basketball camps or something that's at an outside facility. Even though that facility is not owned by the institution is controlling the use of those facilities. So that soccer camp that they're hosting that's 2 hours away from campus, that becomes part of your geography because you are controlling the activities on that campus by your students. Public property comes into play as well. What constitutes public property? Obviously, the school doesn't own the sidewalk or the street that goes through campus. They don't own that. They may not own the parking facility. It may be owned by someone else. But if it's controlled or owned by the institution that's next to, it's still considered public property, and those streets and sidewalks becomes part of the campus because it's considered immediately adjacent or accessible from campus. So public property in that surrounding contiguous area is also considered part of the Clery Act. So you have to report any crimes that occurs there as well. Three key elements of public property. One is it's obviously publicly owned. It must be within or adjacent to campus and accessible from campus. So if there is private property near your campus, be sure that hopefully those signs are up to say private property, because the Clery Act kind of ends where the private property begins. So if there is a private property right next to your campus, you want to really distinguish where that private property begins, so it's not part of your Clery Act and part of your reporting. One thing to note too, I mentioned Clery, but there's also Title IX, and Title IX actually extends further than Clery. The Clery Act is really more part of your campus. Title IX, so any off-campus event that's officially recognized by student organizations, and if any sexual harassment occurs at that spot, the institution could be obviously held liable. So Title IX doesn't have that geography limits that the Clery Act does. Basically, the only geography limits of Title IX is a person in the United States. So that could be anywhere. And really, you have to be concerned about would be if a fraternal organization has a convention that's held out of state. That becomes part of your Title IX. It might not be part of your Clery, but it could be part of your Title IX. So the school still could be held liable should an incident occur at one of those obviously off-site places. What are reportings required? Obviously with the Clery Act, I mentioned, we're talking about obviously have that annual report, and that annual report is due October 1st of each year. It also includes a fire safety report, and you're really reporting crime statistics for the 3 prior calendar years. So if you're looking at October 1st of 2023, you'd be reporting the 3 previous calendar year ends for your institution. Obviously, this is going to be inclusive of everything that goes into that, but some of the policies, having policies, should be make sure institutions follow state statutes, regulations. That's number one, but also having policies on alcoholic beverages, underage drinking, what are considered legal drugs, programs on substance abuse, programs to prevent dating violence, domestic violence, sexual assault, information regarding sex offenders and descriptions of both emergency response and evacuation procedures. So all that needs to be within Part 3 of your reporting. Also included would be policies on missing student notifications, policies on reporting campus crime, policies on security of off-campus or campus facilities, and then policies on enforcement of security personnel working with your campus police and so forth. So all those policies in Part 3 need to be part of your reporting. The annual security report also must include descriptions of programs to really inform students about the prevention of crime. That's the key thing, is really you want to prevent the crime. You don't, the reporting of it's necessary, but the key obviously is the best you can do to prevent that crime. Really types of programs designed to really inform the campus of the security procedures, encouraging students obviously to be responsible for their own acts as well. Should be have also policies on possession use of alcoholic beverages, statement that really talks about that it would provide in writing both to the accused and the accuser the results of any disciplinary procedures. So if obviously there's a right to fair trial and fair process, in that the institution's procedures for both the accused and the accuser to appeal the results, that is something that would be available should the outcome not occur in favor of one or the other. Any institution that has campus police has to maintain a daily crime log. So if you have campus police or a separate security department, most schools do. Obviously, if they have on-campus housing, they're going to have that. And even schools that don't have on-campus housing, most of them have either campus police or security department. So those daily crime logs have to be maintained. And also having a policy that, in the security report should have a statement that talks about, what is dating violence, what is domestic violence, sexual assault and stalking, and what procedures institutions will follow should one of those crimes be reported. I'm not going to talk a little bit about, I'll skip a little bit over this slide, but this slide is really talking about procedures for specific offenses contained. Make sure you have these components that are in there. We talked about those already, about what educational programs do you have and campaigns to try to include or increase really the awareness of what dating violence is, what domestic violence, what constitutes domestic violence, stalking, those type things, making sure that prevention, because obviously you want the schools, as I mentioned, to prevent it as best they can and make people aware, what's not acceptable, what's the definition of consent. Those type things need to be in that policy for the institution. Also, what procedures should follow if a crime has been committed. Obviously preserving evidence is key, and how and whom the offense should be reported to. But also you want to be able to protect the victim, and the victim has options. The victim, if wanted, the victim, you could help notify the proper authorities, assist in notifying enforcement if the victim chooses, or in fact, even decline to notify authorities. That's really up to the victim at that point. The rights of the victim is really, even for orders of protection, things like that as well. Those type things would be important, that the victim has that right to be able to decide how to inform the campus or with law enforcement. There also needs to be a statement about how that confidentiality of victims will happen. Obviously, the student could obviously want to be confidential about their identity. Written notification about, if there's a program about, getting help or counseling, that should be available as well. And then, understand victims' rights for changing academic or living or transportation. Obviously, if an issue happened at a dormitory, that the school should have a policy to be able to move that student to another location that they feel more safe, or if they're in a working situation. Clearly, if they were working at the school and an incident occurred, that student would have the option of be able to go be transferred somewhere else where they feel obviously more safe. And obviously, if there's going to be proceedings on disciplinary proceedings, making sure that those steps and timelines are filed in according to what the standards say. making sure that there are sanctions if that involves expelling a student or criminal charges, those things, and as I mentioned, is protective measures against for the students. Any of those proceedings that happen at a school should obviously be conducted by trained officials, and both the accuser and accused will have the same opportunity to present, have others present, should that be an attorney, at those hearings. And then finally, the last one is that both parties, the accused and accuser, should have a written notification of the outcome at the same time, and they have that ability to appeal if necessary. The annual fire safety is also important to talk about the statistics for that's submitted to the department. Anything on fire, how many fire alarms went off, number of drills, things like that. Procedures for evacuating, policies on fire education, all those things relate to the fire reporting. That's something that's important as well. Any institutions that obviously have on-campus housing have to do the same thing as I mentioned, the daily crime log, where they have to have a fire log as well that mentions anything that happened on campus as relates to fire safety. And then missing persons and procedures, schools have to have a policy on how to report a missing student. Typically, it's after 24 hours. So it has to be, who do you report that to? Like if you have a roommate, what's the steps to report that missing student? And then making sure that each student has a contact person that the school will notify whenever that 24 hours expires. Emergency response, evacuation, notifications, timely warnings. Obviously, those are important as well, including your Security Act, to be sure that you have appropriate steps to take place should an emergency on campus happen. What's your system of notification of other employees and students, and how that system actually initiates. Real quick on the difference, what is an emergency notification versus a timely warning? Emergency notification is really something that's occurring imminently and it's occurring right now. That's something that you should, if it's happening on campus, that how timely it has to be immediately upon confirmation of situation. Timely warning is a little bit different, but it's really anywhere on the clear geography versus whatever the threat is.
Ray, as we're coming up on time here, yep.
The next key word is 495. It's our last one of the day, 495. And we're going to quickly go through the last slide. Really just an update. The GLBA requirements were changed slightly in the last year. June 9th was the new date for them to be sure you're compliant with them. So hopefully most schools on this call today have already taken these steps, but just in case, kind of refresh, you're really protecting the security information of student information, protecting against hazards of that security, and obviously unauthorized access. What it did really is this new GLBA Act is incorporated elements, and now there's 9 elements, 7 if your school has less than 5,000 students and former students, that would be a pretty small school, but there's 9 elements. The first one's designating a person that oversees the program. Next is providing a risk assessment, element number 2. Element number 3 is having safeguards to control the risk. So once you've identified the risk in element 2, what are your safeguards to control those risks and help the institution? Element 4 provides for having a regular testing of the effectiveness. Obviously, having safeguards is great, but if you never test them, you're not going to really know if they're working. So element 4 is making sure there's a regular test or monitoring of them. Element 5 is making sure that personnel can enact this information program, security program, that you have personnel in place that would do it. Number 6 is really addressing how you'll oversee its system or service providers. Keep in mind, schools do have outside service providers in certain situations with either IT or financial aid, things like that. Element 7 is, can you make adjustments should your monitoring detect issues? So if your monitoring detects issues with your GLBA, do you have procedures in place to be able to make modifications and changes to those? And finally, as I mentioned, if you're a school of more than 5,000, remember that's students and former students, so that's going to be probably most on the call. Element 8, institutions, so you have to have all 9 elements. is making sure you have established an incident response plan. So should there be a breach, what is your plan to respond to that plan? That's part of 8. And finally, the last one is making sure you have a qualified individual that reports to the school's administration. So the board and the school, making sure that element is reported to on at least an annual basis. And with that, I've reached the end of my presentation. So I'll turn it back over to Anthony to give some concluding remarks.
Thank you, Ray. If you could just move us to our last slide on the deck here. Again, if you have any questions after you've had a chance to debrief from today, review the materials on that, encourage you to reach out to Nick, Ray, or myself, or connect with us on LinkedIn here as well. On our next slide here, hopefully you're joining us tomorrow for the 3rd and final day of our session. But before you do that, please check out Conferences.io. Again, using the link there or the QR code, make sure you hit check out there. You also should receive a survey when you exit the GoToWebinar session today. Tomorrow, we're set for 9:30 a.m. Central, 10:30 Eastern for day 3, our final session. We hope to see you there. Thanks, everyone.